Welcome to the Deep Dive. Today, we're really cutting through the noise. We're taking you inside Blackstone's second quarter 2025 investor call and their earnings report.
Yeah, we've waded through all the transcripts, the presentations.
But our mission is pretty simple. Pull out the key insights, maybe some surprising facts, and just the main takeaways.
Basically giving you a solid briefing, without drowning you in data.
Exactly. And what's great is we're hearing directly from the top brass, right?
That's right. We've got insights from Chairman and CEO Stephen Schwarzman, President and COO John Gray, and Vice Chairman and CFO Michael Che.
So it's the full picture.
It really is. Lets us understand not just the what, but the why behind the results and, what it signals for the market more broadly.
Perfect. So we're distilling their actual words, so you hear about the results, the record AUM, future plans, hopefully giving you those aha moments. Headline performance and overall growth. Okay, so let's kick off with the headline numbers. Blackstone's Q2 2025. What really stood out performance-wise, especially for investors?
Well, the GAAP net income, that came in at $1.6 billion.
Yeah.
But, investors often look closely at distributable earnings, the DE.
Right, the cash they can actually pay out.
Exactly. And that also hit $1.6 billion. That's 1.213 per share, up 25% from last year. Pretty solid.
Okay.
But what's maybe even more telling, I think, about their core strength is the fee-related earnings, the FRE.
The recurring revenue part.
Precisely. That stable income from just managing client money, that grew, get this, 31% year over year.
Wow, 31%.
Yeah, to $1.5 billion.
Yeah.
It's actually one of their best quarters ever for FRE. Signals a really robust earnings engine there.
That's a huge jump for the core business. And how does that reflect in the firm's overall size? Have they grown much?
Oh, definitely. That expansion is fueling massive fundraising. They pulled in $52.1 billion in Q2 alone.
$52 billion in one quarter.
Yep. And over the last 12 months, $211.8 billion.
Incredible numbers.
It pushed their assets under management, their AUM, up 13% year over year. They hit a new record, $1.21112 trillion.
Over $1.2 trillion.
And Schwarzman made a key point, too. This quarter had the most fund appreciation they've seen in almost 4 years.
So the underlying investments are doing well, too.
Exactly. Good news for their LPs. And they also declared a dividend, $1.03 per share, to key growth drivers and strategic initiatives.
Okay, so beyond those really impressive numbers, let's unpack what's actually driving this growth. What's the foundation for future value?
Well, the leadership pointed to a few key areas, sort of growth engines that have really expanded their earnings power.
Like what specifically?
They're big platforms in private wealth, credit, and insurance and infrastructure. Plus, they've been launching a whole slate of new funds in their drawdown business.
Right. I'm curious about where they're actually putting all that capital to work. Where are they investing?
Good question. They deployed $33.1 billion just in Q2.
$33 billion out the door.
Yeah, and $145 billion over the last 12 months. It's one of their busiest deployment periods ever, actually.
And strategically, where's that money going?
They're really leaning into these big, long-term trends, secular mega trends, they call them.
Okay.
So think digital infrastructure, energy infrastructure, data centers, renewables.
Makes sense.
Digital commerce, private credit itself is a big one, life sciences, and interestingly, India.
India keeps popping up.
It does. And these areas, they're not just deploying there. These are also the biggest drivers of appreciation in their funds. Schwarzman specifically mentioned AI.
Ah, the AI revolution.
Yeah, the huge need for capital, both debt and equity, to build out the infrastructure for AI. He said it's creating really positive dynamics for their business.
So it's like they're filling a gap that maybe traditional finance can't.
Kind of. I mean, banks might struggle with these massive, complex tech infrastructure projects. Blackstone has the scale and the structuring expertise. They're positioned perfectly.
So they're not just growing. They're strategically positioning themselves as like the capital provider for this next digital wave.
Exactly right. And, this links to potentially even bigger opportunities, new markets. Schwarzman mentioned these reports. Apparently, the U.S. administration might issue an executive order soon.
Okay.
It could potentially open up a massive new channel. The U.S. defined contribution market, we're talking 401k plans.
Wow, that's huge. $12 trillion.
Something like that, yeah?
Yeah.
$12 trillion. And John Gray added some color on this later.
What did he say?
He suggested, logically, if this happens, alternatives would probably first get into these plans through target date funds, especially for younger folks.
Makes sense. Simpler access.
Right. And he really emphasized Blackstone's edge here. They have these huge perpetual products like BC Red and Bright with proven track records that can absorb massive amounts of capital smoothly.
Unlike the traditional drawdown funds.
Exactly. Those are more complex, right? You commit capital, it gets called down over time. Less suitable for the sort of daily mechanics and simplicity needed for a 401k. 3, deep dive into specific segments.
Okay, let's pivot a bit and dig into the specific business lines. Their competitive strengths, performance. How about private credit? What stood out there?
Well, zooming out, they've basically built the world's largest third-party credit business. It's huge.
How huge are we talking?
They manage $484 billion just in credit, corporate, and real estate combined.
$484 billion.
Yeah, and that's tripled in just 5 years. The revenue from that platform, up more than 4 times.
Incredible growth.
And they offer the whole spectrum, direct lending, leveraged loans, even investment-grade private credit, kind of a one-stop shop.
Insurance seems like another massive focus for them.
Oh, absolutely. They manage over $250 billion for insurance companies now.
$250 billion.
Yeah. The goal is to be the go-to asset manager for that whole $40 trillion global insurance market.
Ambitious.
Definitely. They just announced a big partnership, actually, with Legal & General in the UK.
Oh, yeah.
Targeting up to $20 billion for that partnership over 5 years, mostly investment-grade private credit and developing some products for the UK wealth and retirement market, too.
Is demand still strong, even with credit spreads tightening a bit?
Apparently, yes. Demand's robust. Clients seem focused on that persistent extra yield that premium private credit offers compared to liquid markets.
How much extra yield?
They mentioned about 190 basis points of excess spread for their A-rated credits.
So nearly 2% extra.
Right. And it highlights how private credit can do these unique, tailored deals like that $5 billion investment in Rogers Communications. Things public markets just can't replicate easily.
Okay, moving on.
Yeah.
Private wealth, another area where they've really pushed hard.
Yes, definitely. They're leading the market there. It's a vast channel, mass affluent, high net worth, $140 trillion globally.
And Blackstone's piece.
They've grown AUM in wealth to almost $280 billion, makes them the biggest private wealth alternatives platform out there.
$280 billion from wealth clients.
And the revenue shows it. Their main U.S. perpetual funds, they brought in over $700 million in Q2 alone.
$700 million. Compared to what previously?
Get this, 5 years ago, it was about $50 million.
Wow, that's astronomical growth.
It really is. Sales in the wealth channel overall were up 30% year over year, $10 billion in Q2. BC Red, their private credit fund for individuals, led the charge.
How much did BCR raise?
$3.7 billion in the quarter, and it's underpinned by really strong performance, 10% net returns annually since it launched.
10% bet is compelling.
Very. Especially in volatile times, it shows why investors are turning to private credit. And Bright, their real estate trust.
How that doing? Real estate's been tricky.
It had its best fundraising quarter in 2.5 years, actually. $1.1 billion raised.
Okay, picking up that.
Yeah, and its returns have been solid, 9% net annually since inception. That's roughly double the public REIT index over the same period.
Double the public market. That's significant.
And they just launched a new one, BMX, multi-asset credit for individuals, spreading exposure.
Got it. What about their traditional base, the institutional clients? What's the momentum there?
Still very strong. Their infrastructure platform, for example, AUM, up 32% year over year to $64 billion.
Driven by performance.
Remarkable performance, yeah. 17% net annual returns for their main fund since inception.
17% in infra.
Yep. And their multi-asset business, BXMA, fastest growth in almost 7 years. AUM up 13% to a record $90 billion. And it's incredibly consistent, 21 straight quarters of positive returns.
21 quarters. That's over 5 years.
Exactly. Then in the traditional drawdown funds, they pulled in another $3.5 billion for their new Asia private equity fund.
How big is that fund now?
$8 billion total. It's already 25% bigger than the last one, and they expect to beat their $10 billion target.
Okay.
Their secondaries business, buying existing fund stakes, that's doubled in 5 years to $91 billion. Raised more for its fourth infra secondaries fund, now over $5 billion.
Bigger than the last one, too.
Nearly 40% bigger. And they just launched fundraising for their main PE secondaries flagship, targeting at least the size of the prior one, which was $22 billion.
$22 billion for secondaries. Huge scale. Market outlook and realizations. Okay, so we've seen all this growth, the fundraising, the deployment. What does it all mean for their view on the market? And crucially, their ability to actually, cash out on these investments, realizations.
That's the big question, isn't it? Is that pause in deal-making really over? Blackstone seems to think so.
What makes them say that?
Well, first, they reported strong fund appreciation overall in Q2, the best in nearly 4 years, even with market swings.
Okay, solid performance helps.
And Schwartzman highlighted their own internal data. He said it shows inflation is actually below the Fed's target if you adjust for how they measure shelter costs, which lag reality.
Interesting point.
So they expect inflation to stay muted, which should give the Fed room to cut rates eventually. And lower rates generally boost asset values and encourage deals.
Right. What about real estate specifically? That's been a tough spot. They sound confident, though.
They really do. Connecting back, they basically called the bottom for real estate about 18 months ago.
Ahead of the curve.
And they've been buying since then. They admit it hasn't been a sharp V-shaped recovery, but they're seeing positive signs now.
Like what?
New supply is dropping sharply, debt costs are coming down, transaction activity is finally starting to pick up.
And their portfolio positioning helps.
Absolutely. About 75% of their global real estate equity is in things like data centers, logistics, rental housing, defensive, growth-oriented sectors. So yeah, they express high confidence in the eventual recovery.
That is a notable shift in tone for real estate. So what else gives them confidence that overall deal activity is picking up?
Well, they pointed to the U.S. stock market hitting records, M&A picking up pace, especially sponsor-led deals, and the IPO market starting to reopen.
The IPO window creaking open.
Seems like it. They actually did a decent-sized IPO in Europe recently. First one from their PE or real estate portfolios outside India in several years.
Okay, that's a positive signal.
And they said they're prepping other companies to go public too. They have their biggest forward IPO pipeline since 2021.
So if markets stay supportive.
Exactly. If these conditions hold, it should really accelerate their realizations, cashing out of investments. They see a potential step up in activity later this year, heading into 2026.
And they have firepower ready for new deals too, right? The dry powder.
Oh, yeah. A massive $181.2 billion ready to deploy.
Huge amount.
And what's really fascinating related to future realizations is their net accrued performance revenues hit a record $6.6 billion.
Explain that. What does that mean?
That's basically the performance fees they've earned on paper from the appreciation in their funds, but haven't yet collected in cash because the investments haven't been sold.
So $6.6 billion of potential future cash flow locked in, waiting for realizations.
Exactly. It indicates significant embedded value and future profit potential, V financials, and shareholder value.
All right, let's wrap up by looking at the firm's financial health itself and how all this performance translates into value for the shareholders.
Sure. So their base management fees, that super stable revenue stream, up 14% to a record $1.9 billion in Q2.
14% growth in management fees.
Yeah, and it's the third quarter in a row of double-digit growth there. Transaction and advisory fees were also up 25% year over year. Their capital markets business had a record quarter contributing to that. And those fee-related performance fees we touched on, from perpetual funds like BC Red and Bright, they hit $472 million in Q2.
How does that compare?
It's more than 2.5 times what they generated in Q2 last year, and it came from 8 different perpetual strategies.
So broad-based contribution there.
Very broad-based. Add it all up, total fee revenues hit $2.5 billion in the second quarter. That's up a remarkable 27% year over year.
27% growth in total fees. Impressive. How does that flow down to shareholder returns, dividends, buybacks?
Well, looking at the last 12 months, their distributable earnings, the DE, rose 26% to $6.4 billion, or $5 per share.
Okay.
And that directly fueled a 26% jump in their dividend over the same period. It reached $4.26 per share.
What kind of yield is that?
Works out to about 2.4% yield on the current share price, which, is double the S&P 500's yield.
Attractive payout. Buybacks too.
Yep. They bought back 0.2 million shares in the quarter, 1.7 million over the last year. All told, they returned $1.4 billion to shareholders in Q2 and $5.8 billion over the last 12 months through dividends and buybacks combined.
Strong return to capital.
Yeah.
And the balance sheet itself, how healthy is it?
Rock solid. They've got $10.6 billion in cash and equivalents, treasury investments, etc., and $20.5 billion in total cash and net investments on the balance sheet. That's about $16.64 per share.
Plenty of liquidity.
Absolutely. Plus, they have top credit ratings, A+, A+ from S&P and Fitch, and a big $4.3 billion credit line that's mostly undrawn. So, exceptional financial flexibility. Outro.
Wow, what a comprehensive deep dive that was into Blackstone's Q2. We've really seen how their focus, that strategic focus on big trends, innovation, wealth and credit, disciplined investing, it's all paying off.
Yeah, outstanding results, really. And it positions them so well for continued growth, even in, what's still a pretty dynamic market.
Their ability to just keep delivering for investors, even when things get turbulent, it really speaks volumes about their diversified model, doesn't it? And that forward thinking.
It does. And what's really fascinating, I think, is how they're not just playing the market, they're actively trying to shape it. You see that with the potential opening of the 401k market to alts.
Right, trying to influence the rules of the game.
Exactly, that focus on long-term trends plus all that dry powder. It just suggests they're ready to jump on whatever opportunities come next. They're almost setting the pace for the whole industry.
So as you think about everything we've covered today on Blackstone's Q2 results, here's something to chew on.
Huh.
With all those different growth engines firing and that mountain of cash ready to invest, how else might Blackstone innovate and shape the alternatives world? What surprising new markets or maybe investment themes could become their next big frontier?